Most people don't lose money because they chose a bad investment. They lose money because they chose the wrong type of investment for their reality. A man buys land that never sells. Another buys gold that never grows. A third buys stocks he never understands. All three say the same line later: "I thought it was safe." This video was made after a long research. To encourage us, like this video and subscribe to Zhao's Capital. Today we're going to answer a question that looks simple but ruins portfolios every year. Real estate, gold, stock exchange. Which is best? Which is secure? Which one actually works right now? Not theory, not textbook talk, just real mechanics, real pros and cons, and the uncomfortable math behind each. And I want your opinion too. If you had to put all your savings into just one of these, which would you pick and why? Comment below, I read them. Let's start with the one people trust the most: real estate. There is a reason parents across cultures say, buy land, they're not making more of it. It sounds wise, it sounds permanent, it also sounds like it cannot go to zero. Real estate feels safe because you can touch it, stand on it, paint it, rent it, pass it down. It feels real. Stocks are numbers, gold is metal, property is identity. But here's the hidden mechanism most buyers ignore. Real estate is not just an investment, it is a business. It has maintenance costs, legal cost, tax cost, vacancy risk, liquidity risk, time risk. If you buy a rental property, you are now in the tenant business, whether you like it or not. Let's say you buy a property for $100,000 equivalent. You rent it and get $500 a month. Sounds like a 6% yearly return. Nice. But subtract repairs, tax, empty months, broker fees, paperwork, inflation. The real return often drops closer to 3 to 4%. That's before we talk about price growth. Yes, real estate has created generational wealth, especially in growing cities. According to long-term housing data across major economies, property tends to appreciate slightly above inflation over decades, not explode every year like social media claims. Pros of real estate: it's tangible, it can generate rental income, it can be leveraged using loans, it is less volatile day to day. Banks love it as collateral. Cons: it is illiquid. You cannot sell one bedroom when you need cash. It requires large capital. Transaction costs are high. Prices can stagnate for years. Bad location equals dead money. Japan's property market took decades to recover after its 1990 crash. Many investors waited 20 years just to break even. No one shows those charts in advertisements. If you own property, good. If all your wealth is only property, risky. Pause here. Quick question. Do you see real estate as an investment or a lifestyle asset? Comment that. It changes the strategy completely. Now let's talk about the oldest safe haven story ever told: gold. Gold is interesting. It produces nothing. It pays no dividend. It builds no factories. It employs no employees. Yet humans trust it more than governments. Why? Because gold is not just an asset, it is insurance. When currencies weaken, when inflation rises, when fear spreads, gold usually wakes up. During major crises, 2008 financial crash, pandemic panic, currency shocks, gold prices often spike as investors run toward perceived safety. Central banks themselves hold gold reserves for this reason. But here is the quiet irony. Gold protects wealth better than it grows wealth. Over very long timelines, gold roughly keeps pace with inflation plus a little extra. Stocks historically outpace it. Businesses grow. Gold just sits. Think of gold like a fire extinguisher. You're glad you have it. You don't expect it to cook dinner. Pros of gold: high liquidity, easy to sell almost anywhere, hedge against inflation and currency decline. No counterparty risk when held physically. Crisis protection asset. Globally recognized store of value. Cons: no income generation. Storage and security issues. Long, flat periods with no growth. Emotional buying during hype cycles.
premiums and spreads when buying physical gold. From 1980 to 2000, gold delivered almost zero real return after inflation, 20 years of waiting. Many investors forget that part. Today, gold is trending again, mainly because of inflation concerns, geopolitical tensions, and central bank buying, but trend does not always equal timing. Let me ask you something here. Do you buy gold for growth or for sleep-at-night safety? Write that below. Now we move to the most misunderstood and most argued battlefield, the stock exchange. People hear stock market and imagine chaos, gambling, crashes, charts, and shouting traders. That image is outdated. Modern stock investing is ownership. When you buy stock, you buy a slice of a business. If the business grows profits over time, the stock tends to grow. Not every day, not every month, but over cycles. Historically, and this is backed by over a century of market data, diversified stock indexes have delivered the highest long-term returns among major asset classes. Finance professor Jeremy Siegel's long-term studies show equities outpace bonds, gold, and cash over multi-decade periods. But this matters. Stocks are volatile. They fall fast. They scare people. They test patience. A portfolio can drop 30% in a year and recover later. If you panic sell, you lock in loss. If you understand cycles, you survive them. Pros of stock investing: high long-term growth potential, easy diversification through index funds, low entry barrier, high liquidity, dividend income possible, ownership in real businesses. Cons: short-term volatility, emotional decision risk, requires discipline, market bubbles exist, bad stock selection can destroy capital. Now here's the uncomfortable math. If an asset grows at 8% annually, it doubles roughly every 9 years. That's the power of compounding. Broad stock markets historically hover around that long-term range before inflation, though not guaranteed every period. Gold does not compound. Property rarely compounds that fast after costs. Businesses can. That's why many modern portfolios lean towards equities for growth, gold for hedge, and real estate for stability or income. Now let's talk about what is trending nowadays. Globally, passive stock investing through index funds and ETFs is growing fast. Low-cost funds that track entire markets are attracting both retail and institutional money. That trend is strong because data shows most active traders underperform indexes over time. Real estate is trending in specific high-growth urban regions and through REITs, real estate investment trusts, which allow people to invest in property portfolios without buying buildings directly. Gold demand is trending mainly through ETFs and central bank accumulation, especially during inflation cycles and geopolitical uncertainty. Notice a pattern. Access is becoming financial, not physical. Paper ownership, fund structures, fractional investing. Here's a simple way to see it. Real estate is slow, heavy, and local. Gold is stable, defensive, and emotional. Stocks are dynamic, productive, and volatile. Different tools, different jobs. If someone tells you one is always best, they are either selling something or simplifying too much. Let's raise the stakes. Security is not just about asset type, it is about behavior. A disciplined stock investor beats a careless property buyer. A patient gold holder beats a panic trader. A diversified planner beats a one-asset believer. Portfolio design beats asset worship. Quick pause. If you enjoyed deep, research-driven finance breakdowns without hype, like the video and subscribe to Zhao's Capital. It tells the algorithm this kind of content matters. Let's zoom out. The biggest risk today is not choosing the wrong asset. It's a concentration risk, putting everything in one basket because it feels familiar. Housing crashes happen, market crashes happen, currency crises happen. History repeats, just with different headlines. Smart allocation is boring, but it survives. A balanced approach many experts discuss looks something like this in principle. Growth assets, defensive assets, and real assets combined. Exact ratios vary by age, income, and risk tolerance. Not exciting, very effective. Before we close, I want your view again. Which scares you more, market crashes, property stagnation, or currency inflation? Comment on it. Your fear often reveals your bias. Final thought, the best investment is not the one with the best story. It's the one whose risks you understand and can live with. Because returns are mathematical, but staying invested is psychological, and most people lose the psychological battle. So here's the unresolved question I want you to think about tonight. If all three, property, gold, and stocks, dropped by 25% tomorrow, which one would you still have the courage to hold? Tell me in the comments. That answer is closer to your real strategy than any expert advice. I'll see you in the next one.